Should you go cap weight or equal weight S&P 500 index? This is a great article that one of you all had sent to me, which this changed my opinion. This right here changed my opinion, bar none. So let's go into the S&P 500, how it works. All right, hold on. Let me just close my door here. In case we got Ratman, i.e. Pablo, wants to jump in here, it's fine, but he's supposed to be hanging out with my sons. All right, so the S&P 500, how it works, is a market cap index, i.e. The biggest companies represent the biggest constituents of the index, all right? So if you have Heritage Wealth Planning is the 500th company on there, and I guess it'd be Amazon now would be the first company. There's a significant difference between the two in terms of the weighting structure. So if Heritage Wealth Planning went bankrupt, it's not going to affect the S&P 500 that much. If Heritage Wealth Planning went, quadrupled in value overnight because everyone loves Pablo and they say, yes, I love him, it wouldn't affect me that much, the index at all that much either. Amazon or Apple, on the other hand, would kill it. I mean, there's no other way around that. So this is how, either on the plus or downside. So there's more risk in the S&P 500 relative to it being focused on companies that are the biggest constituents. Hope that makes sense. We'll read about this here in just a second to give you an example of how this works. But the interesting thing is, if you look back over some times, well, what happens is that equal weighted, which would be every constituent has a 1 out of 500th position in the S&P 500. So we take 500 we take 1 divided by 500, and that's not even a 2, a 0.002. Was that 20? I don't even know what that is. 0.002. So each company represents 0.002% as a position in the S&P 500. And that means if Heritage Wealth Planning does amazingly well, it has just the same up and downside as if Apple were to do that. And so that's interesting because you're like, man, I don't know if I want to be putting too much eggs in my basket on these stocks that have done incredibly well relative to the ones that are undervalued or don't hold as much of a position in the index. It's a tough one there. I think about this quite a bit, actually. And the bonds work the same way, by the way. If you look at the total bond market, Vanguard, BND, for instance, is the biggest debtors that are out there. The U.S. government and all the biggest corporations that carry the most debt. So inherently, you're buying the countries and companies with the most leverage, most bonds, most debt. The S&P 500 index is different, though, because it's not about debt. It's literally about market cap. And how do you get a big market cap? Well, you got a price. It's number of shares times your price. And if you have billion, trillion, million shares, but you're only trading at 1 penny, you're going to have whatever that is. If you have one share and it's trading at a billion, trillion, million, whatever, you'll have that's your market cap. So you can see what happens is the companies with the higher share prices essentially dominate the market in the S&P 500 relative to the high share prices, relative to the number of shares outstanding. So let's read this article from my man Mark Holberg. I've been reading Mark for a long time. I'll just give you an example of who Mark is. As a matter of fact, I hopefully get his regular contributor. Market Watch is Holberg Ratings, tracks investment newsletters that pay a flat fee to be audited. Yeah, I'm a big fan of Mark. So this took me by surprise. I read this article on our live stream that we did last week, and don't forget, every Sunday at 7:30 EST Eastern Time, there will be a live stream right here on YouTube. All right. One weighs companies by market value. The other treats them equally. This is the better of the two. I'm telling you, this took me by surprise. Apple, the stock with a margin, this is back in December of 2019, so things might have changed now. The Apple is the largest stock in the S&P 500 index, is a better bet than the stock with the smallest TripAdvisor. But just how much of a better a bet as it is. With a market cap of over $1 trillion, Apple has more than 320 times the portfolio weighting in the S&P 500 than does TripAdvisor, whose market cap is $113 million. Is Apple really worth that much more? I didn't realize the S&P 500 is all the way down to only $113 million. That's definitely getting the mid-cap realm for sure. Many on Wall Street says Apple is not worth 320 times that of TripAdvisor. After all, when picking stocks for your portfolio, you have an equal chance of picking TripAdvisor as Apple. Wouldn't the S&P 500 index be improved if it gave equal weight to all 500 stocks? Their argument gained particular credence in the years immediately after the 2008 crisis, when the equal-weighted version of the S&P 500 significantly outperformed the cap-weighted. In 6 of the 8 years from 2009 to 2016, the equal-weighted version came out on top, as this chart shows. You can see cap-weighted, equal weight. Equal weight is the blue, cap-weight is the red. You can see equal weight did, equal weight, cap weight, equal weight, equal weight, equal weight, cap weight, equal, cap, cap, and cap. Ooh, look at that. In the last 3 years, so interesting, huh? So let's see. At a minimum, therefore, it just goes to show that nothing comes out on top forever. I would argue the cap-weighted version of the S&P 500 is the better bet for long performance, because the equal weight has, from 2009 through 16, it did. In the last 3 years, the S&P, the cap weight did. To understand why Mark says this, says why, it's helpful to step back and consider what we mean when we talk about the market. It is nothing more than the combined value of all shares. By definition, therefore, the market is cap-weighted. A stock with a large market cap will have a greater weight than one with a small market cap. There are at least 3 reasons why the equal-weighted version of the S&P 500 will lag over time. Questionable style and sector bets. When investing in the equal-weighted version of the S&P 500, you're in effect making 2 specific style and sector bets. The recent winners will quickly turn into losers and vice versa. That's because the equal-weighted version of the index is constantly selling portions of its biggest winners and buying additional shares in its biggest losers, so that all holdings remain at equal bet. This is an anti-momentum or contrarian bet. Some would say a value bet. I'm not sure if I'd make contrarian and value-oriented synonymous here. Number 2, small caps will outperform large caps. That's because the small cap stocks will have a greater weight in the equal weighted version and then in the cap weighted version. So again, if you're going for the equal weight versus the cap weight, you expect small caps to outperform in the long run. Historical data are clear that you should avoid the first of these 2 bets, that small caps outperform and that recent winners will quickly turn into losers. We don't know that to be true. According to French Fama, who does a DFA, the Dimensional Fund Advisors, the evidence-based research, a portfolio of stocks that have done the best over the trailing year far outperform a portfolio containing the trailing year's worst performers. It's not even close. In fact, over the last 92 years, momentum beats contrarianism by an annual percentage of 7 percentage points. Cap-weighted indices are able to exploit this momentum effect because they don't sell portions of stocks that have done well. Essentially what's happening here, any momentum trend followers that say, cut your losses and ride your winners. It's just that simple. The data are more mixed when it comes to the second bet about small versus large cap. On the one hand, over the 92-year period, small caps have outperformed large by an annualized percent of 2.3. On the other hand, this average is not nearly big enough to overcome the hole created by betting against momentum. So you might get 2.3 on the small side, but you're losing 7% on the momentum side. Historically, we don't know going forward. Furthermore, that there is evidence the small cap advantage has largely disappeared. I completely agree with this, actually. Over the last 30 years, according to French Fama, there has been no difference in the average performance of small and large cap stocks. And again, going back to Siegel and I guys' books all over the place back there, if you take out like a 6 to 8 year time frame from I want to say 74 to 82 or something like that, small cap stocks do not outperform. It's just this tiny slither and where they did so much better that they did outperform. Equal weight version is riskier because the equal weight version of the S&P 500 is more heavily exposed to small caps, is more likely to be riskier than the cap weighted. That's not a criticism, but it means the equal weight version will have to have far outperformed the cap weighted version in order to merely equal it from a risk adjusted perspective. Consider Morningstar data for the last 10 years. In terms of beta, the equal weighted S&P 500 is 7% riskier than the cap weighted. In terms of volatility, it's 8% riskier. Now, as a result, the equal-weighted version significantly lags the cap-weighted version when it comes to risk-adjusted performance. Higher transaction costs. The above 2 considerations are theoretical and therefore don't take transaction costs into account, but the cap-weighted version's advantages increases when we do, since ETFs benchmark to it have a much lower expense ratio. The IVV, the S&P 500 from iShares, has an expense ratio of 4 basis points. In contrast, the 20 basis points for the Invesco equal-weighted ETF, which is RSP. Note also that the equal-weighted version will have to undertake far more transaction than cap-weighted ones, since it must periodically just level it off. The S&P 500 index will let the winners ride, and every now and again to replace something they're going to move out of the market of the S&P 500 and replace with something. But that happens quarterly, and on top of that, we're talking about 15 issues a year. There's not selling of every single holding. So let's see. Notice that the equal weight version will have to undertake far more transactions, since it must periodically sell portions of its winners to buy additional shares as losers just to maintain the equal weighting. Though brokerage commissions have shrunk to zero, bid-ask spreads have not, especially on the small cap stocks that enjoy a greater weighting in the equal weighted version. These transaction costs are above and beyond the greater expense ratio. These transaction costs are above and beyond the higher expense ratio of the equal weighted S&P 500 anyway, and you don't see transaction costs. In the prospectus, we don't know exactly what a cost of transaction costs. One of John Bogle's and Morningstar's pet peeve is, how do we quantify this? No one knows. The bottom line, as we all know, the market is hard to beat, very hard. And when it comes to S&P 500 stocks and the S&P 500, the market is a cap-weighted version. Yeah, I couldn't agree with that more. So anyway, there you go. I would go with the S&P 500 market cap-weighted VOO for Vanguard, or IVV for, I'd go Vanguard. And then I don't even know what the equal-weighted version of Vanguard even offers one. Hope that helps. All right, feel free to comment down below. Thanks now.